We've been talking a lot about this idea of whether the profit recession is behind us, even if we get a broader US recession next year. Do you think that's likely?
No, we think the worst is yet to come. We're looking for a moderate recession next year, which means a moderate decline in corporate profits. Our target for the year for the EPS for S&P 500 stocks is about $205 a share. Much like Morgan Stanley, I think our view is below the market consensus at the moment. We do see that recession beginning during the early part of the year, which is a bit before the consensus as well. But that will pose a more challenging environment, we think, for the stock market. And as you mentioned, careful what you wish for. If that inflation rate's coming down, it's to some extent a byproduct of a slower economic growth environment.
What do you mean by quality then? What are you looking at if we're going to be more selective and more careful next year?
Well, our focus continues to be on the U.S. market. We think the U.S. Will hold up a bit better in the midst of a global recession. We do look for a moderate recovery in China. Getting to that 5% growth target, we think, will be difficult. There will be growth, but it will be moderate. The European recession, which already may be underway, we think will be a bit more severe than the U.S. market. So the focus is here. It's on liquidity, which means large cap stocks. It's on quality in the midst of a recession, which means strong balance sheets, resilient earnings growth. And it also means sectors, a focus on sectors that are less sensitive to the economy's ups and downs, like healthcare.
Some of those large caps, especially multinationals, have been really challenged because of the stronger dollar. Does this concern you going into 2023?
It does to some extent, given the disproportionate share of earnings that are generated overseas. As the Fed begins to pull back, we do see a dollar peak sometime during the early part of 2023. So that headwind should begin to dissipate and perhaps even turn into a tailwind as we move toward the latter part of the year. There are other attributes to those large cap stocks, however, that support our view, favorable view toward that part of the market. Liquidity, earnings resilience overall, healthy balance sheets and the like.
What about fixed income? Where do you find the opportunities?
Really more of a barbell strategy at the moment. We think that shorter duration assets, very short-term assets, will be able to ride further yield increases, interest rate increases, higher with the credit rate increases by the Federal Reserve into the early part of 2023. At the longer end, the yield on longer dated securities is still reasonably attractive, even in an inverted yield curve, particularly in anticipation of a break in interest rates, moderate decline in interest rates during the latter part of the year, which of course for long duration assets provides a lift to prices.
The great countercyclical hope is now China, if we get a broad-based reopening at some point next year. How do you get exposure to that?
Well, we still think that for a moderate recovery, the focus should continue to be on those favored sectors of the economy, perhaps less economically sensitive sectors like healthcare, consumer staples, and those less economically sensitive sectors. We're still a little bit skeptical of a strong consumer-led recovery. It may be consumer-led, but we think that with COVID infection rates on the rise, that will act as a restraint through the early part of the year, and that discretionary spending may be more problematic. The government will be focusing on investment, perhaps in the industrial sector to some extent, but in a difficult global environment, we think there will be headwinds there as well. So much the same strategy toward less economically sensitive sectors of the market. And that holds for multinationals selling into that market as well.